Welcome to the Research Desk. How do you distill dozens of metrics, hundreds of data points, and 6 layers of market reality into a single number that a human brain can actually trade on? Today we are dissecting the architecture of the 0 to 100 composite score system. I argue that this scoring framework is a masterpiece of fundamental and quantitative synthesis. A score of 80 is mathematically, philosophically, and practically distinct from a 79. It represents a precise equilibrium of valuation, momentum, and macroeconomic conditions. The single number is the cognitive anchor that allows portfolio managers to execute complex capital allocation without falling prey to decision fatigue or emotional bias. The human mind simply cannot continuously weigh 50 conflicting variables in real time under the pressure of active markets. This system translates multidimensional chaos into a single undeniable directive.
I approach this architecture from an entirely different angle. The number itself is merely an illusion of control. The true power of this system lies entirely in its harsh restrictions, the gating architecture, and the override hierarchy. It does not matter if a model perfectly calculates a 95 for a specific equity if the underlying market conditions have deteriorated to a point where the signal is meaningless. The brilliance of the framework is its ruthless capacity to veto any score, the negative space, the explicit rules that prevent capital from being deployed is what ultimately protects the portfolio from market noise. We spend so much time obsessed with what the score tells us to buy, but the structural genius of this framework is entirely predicated on what it forbids us from buying.
Well, moving into how we actually use this in practice, human cognition absolutely requires a composite score. Without a standardized 0 to 100 scale, portfolio managers they drown in conflicting signals.
They do, but
a quantitative system can generate, 1,000 predictive indicators. But if the individual allocating capital cannot synthesize those indicators into a coherent thesis, the entire system fails. The fixed weighting system where fundamental gravity walls hold the maximum weight creates this undeniable center of gravity for capital allocation.
Right.
It forces discipline, right? By quantifying exactly how much conviction is justified by the data. The score anchors the human mind to empirical reality. When you have a framework that scales continuously from 0 to 100, you are providing a visual and really a cognitive heuristic. It removes the paralyzing friction of ambiguity.
A heuristic, sure. But is it always accurate?
Well, if a manager is looking at a company with expanding margins but a deteriorating macro backdrop, they don't have to guess which force is stronger. The composite score has already weighed the variables, resolved the conflict, and presented a unified thesis.
Okay, but what good is a score of 95 if the market has simply stopped computing? You described the 0 to 100 scale as this elegant cognitive anchor, but a high score can so easily seduce a portfolio manager into deploying capital into a structural trap.
I wouldn't call it a trap if the math holds up.
But the math doesn't always hold up to the macro environment. The architecture's genius is not the composite number itself, but rather the economic restrictions that actively starve bad ideas of capital before they can, manifest as actual portfolio risk.
Yeah, the gates.
Exactly. The override hierarchy and those 7 hard gates are literally the only mechanisms standing between a portfolio and catastrophic market noise. They provide the necessary friction to stop an automated, highly optimized score from driving a portfolio straight off a cliff. Think of the score as the accelerator of a high-performance vehicle.
Okay, I like that analogy.
Right? It's thrilling to press down on it, and it feels like progress. But what keeps the driver alive is not the accelerator. It's the braking system. It's the stability control. If the road ahead has collapsed, I frankly do not care how perfectly the engine is tuned. The gates are the braking system, and they are absolute.
Fair point. But to understand the score, and the gates, for that matter, we have to start with the raw components. And that begins with the heaviest weight, which is fundamentals, the gravity walls.
Right, the 25 points.
Exactly. They carry a maximum of 25 points out of the 100-point scale. Now, for the uninitiated, when we talk about gravity walls, we are talking about rigid fundamental boundaries.
Earnings yield, free cash flow generation, balance sheet durability. This is the literal financial gravity that keeps a stock from floating away on speculative hype.
And the curve is quite steep there.
It's intentionally steep. It reflects the binary nature of structural integrity. 4 green walls earn the full 25 points. 3 green walls, assuming there are no red walls, earn 20 points. But then 2 green walls drop the score significantly, all the way down to a range of 10 to 15 points.
A massive drop-off.
And 0 green walls, that earns a mere 2 points. Fundamental valuation is without question the most durable signal in financial markets over a long time horizon. Without fundamental support, no amount of narrative, sentiment, or momentum can sustain a long-term position.
True.
Can a building stand without a foundation? Of course not. The gravity walls ensure that a company possesses the economic, structural integrity required to absorb capital. The 25-point allocation anchors the entire composite score to intrinsic value rather than fleeting market enthusiasm. It asserts that, before we look at what the crowd is doing, we have to look at what the business is actually earning.
I hear you. The foundation is mathematically necessary. I won't argue that. But it is entirely insufficient without momentum confirmation. Which brings us to the TrendWise component. And frankly, the harshest penalty within the entire framework.
The 0-point rule.
The 0-point rule. Your 25 points of fundamentals are a beautiful theoretical exercise, but they are entirely useless if the market is aggressively selling that asset. That is exactly why TrendWise exists, to punish you for catching a fundamentally sound falling knife.
It is a painful lesson for value investors.
Oh, absolutely. TrendWise carries a maximum of 15 points. When the trend is confirmed in the direction you're trading, the system rewards you. A right side alignment with an open signal earns the full 15 points. A left side alignment with an open signal gets you 12 points. And we really need to isolate the system's most brutal mechanic here. A right side alignment with a closed signal earns exactly 0 points. This is the ultimate trapdoor.
That 0-point penalty is just a fascinating architectural choice. It actively dismantles the traditional value investing playbook.
Precisely. Because if you are trading a recovery thesis based on those pristine, fundamental gravity walls you just described, but the trend has not confirmed that recovery, the score completely blocks you. It doesn't just mildly reduce your overall total, it actively penalizes you for jumping the gun.
Right.
The 0-point penalty acts as a behavioral safeguard against the human tendency to try and outsmart the market. Portfolio managers look at a stock that has been decimated, they run their discounted cash flow models, they see 4 green gravity walls, and they essentially declare that the market is wrong.
I'm right, the market is wrong.
Cold. It enforces the reality that being early is economically indistinguishable from being wrong. That 0 actively prevents the erosion of capital that occurs while you're just sitting there, waiting for the market to agree with your fundamental assessment.
Yeah. And the interaction between those two components illustrates why the synthesis is so vital. Fundamentals and momentum, they don't exist in a vacuum, right? They exist within market time and corporate life cycles, which is why we have to contextualize the score through its environmental components.
The macro ecosystem.
Right. We don't just measure the asset. We measure the ecosystem in which the asset operates. So the market clock allocates a maximum of 15 points based on where a specific asset sits within its cycle. Let's break down that mechanism. The Phase 2 sweet spot, which is positioned conceptually between, say, 8 o'clock and 10 o'clock on the clock face, earns the maximum 15 points.
The markup phase?
Yes. What is Phase 2 physically? It is the markup phase. It's where institutional accumulation has established a base and the broader market is beginning to recognize the fundamental reality, but retail euphoria hasn't yet set in. It is the period of maximum reliable velocity.
And contrast that with Phase 3, right? The distribution phase, where everyone is highly confident, but the institutional money is already quietly rotating out.
Exactly. A Phase 4 left side position earns 12 points. Phase 1, which is the early accumulation or contrarian despair phase, earns 8 points. But Phase 3 earns a mere 3 points. The mechanism here is brilliant because it mathematically penalizes crowded, late-stage trades while rewarding early or contrarian positions.
It forces you away from the herd.
It really does. Let's say you have a highly popular software stock. It has fantastic fundamentals, so the gravity walls are green. It has strong upward momentum, so TrendWise is open.
Under a simpler model, this stock would score 95, and you just allocate maximum capital. But the market clock recognizes that it's sitting deep in phase 3. The trade is crowded. The multiples are incredibly stretched.
The risk of mean reversion is huge.
Right, the risk of a sudden violent mean reversion is very high. By allocating only 3 points to phase 3, the system forces capital away from euphoria and pushes it toward developing opportunities in phase 1 or early phase 2.
Complementing that clock is the Moat, which also carries a maximum of 15 points. And the distinction here is vital because it isn't just about whether a company has a competitive advantage today. It's about the trajectory of that advantage.
Expanding versus eroding?
Yes, a wide expanding moat earns the full 15. A wide but eroding moat drops down to 9 points. No moat earns 0. The moat functions as a forward-looking modifier on the gravity walls. A company might have excellent free cash flow today, satisfying the fundamental requirement, but if its technological advantage is being, say, commoditized by a disruptor, its moat is eroding.
The cash flow is a lagging indicator in that case.
Exactly. Green walls combined with an expanding moat justify premium positioning because the company isn't just fundamentally sound today, it's actively expanding its competitive advantage for tomorrow.
I completely agree with the assessment of the moat, but it's just one piece of the environmental context. We also really must examine the remaining environmental components, which are corporate stage and sector dynamics. Each of these carries a maximum of 10 points.
Right.
For a corporate stage, a stage 3 or 4 company representing high to mature growth earns the full 10 points. Stages 2 and 5 earn 7 points, Stage 1 earns 4 points, and Stage 6 earns 0 points. Now for sector dynamics, a company residing in both a strong sector and a strong industry earns 10 points. Mixed conditions earn between 5 and 7 points. Both declining earns exactly 0.
Okay, I need to interrupt here because we really cannot just list these numbers as if they're merely additive features. Notice how Stage 6 and declining sectors yield absolute zeros.
Yeah, it's a harsh penalty.
It's more than a penalty. These are not arbitrary point deductions designed to mildly disadvantage a stock. They are the system silently starving bad ideas of capital before they can even form a coherent thesis.
Well, value managers might disagree with that phrasing.
Oh, they definitely would. If you're listening to this and you run a traditional equity, income, or deep value fund, you are probably highly skeptical of this mechanism. You look at mature, slow growth companies with high dividend yields, the classic Stage 6 profile, as defensive cornerstones of a portfolio. A manager might look at a mature, declining Stage 6 telecommunications company in a poorly performing sector and convince themselves it represents incredible value due to its yield and low multiple.
It's so cheap, you have to buy it.
Right. The classic value trap. The system does not care about that narrative. It delivers a 0 in the stage category and a 0 in the sector category. It effectively destroys the overall composite score, instantly dragging it down below the threshold for capital allocation. The zeros are the architectural guardians of the portfolio. They recognize that investing in a dying company in a dying sector is a structural headwind that no amount of cheap valuation can ever overcome.
That is a very compelling way to frame the zeros. But the score isn't entirely rigid, you know? Once those base components are tallied, the macroeconomic environment and structural corporate health must modulate the final output. The system is actually highly adaptive.
Through the modifiers.
Right. We apply 2 distinct modifiers to reach the final score, bridging the gap between static analysis and dynamic reality. The first is the long bull blueprint, which can swing the score by -8 to +8 points based on 6 rigorous conditions.
And these are tough conditions to meet.
Very tough. We measure if free cash flow is growing, if capital expenditure intensity is declining, if the company passes the freeze test, if profit margins are expanding, if the return on invested capital exceeds the cost of capital, and if concentric circles of business influence are expanding. A perfect 6 out of 6 adds 8 points to the score. 0 out of 6 subtracts 8 points.
Let's pause and actually explore the mechanism behind these conditions, particularly concentric circles of business influence. Why do we care about concentric circles?
It's about optionality.
Exactly. Because if a consumer tech hardware company cannot expand its influence into high-margin software services, its moat is essentially static. And the mathematical reality is that static moats eventually erode under cost of capital pressures and competitive innovation. By measuring the expansion of business influence, the long bull blueprint is actively searching for companies that are aggressively taking market share in adjacent sectors. It's a brilliant qualitative metric that has been codified into a quantitative modifier.
Absolutely. And the other conditions operate on the exact same rigorous logic. Capital expenditure intensity declining while free cash flow is growing indicates a business that has completed its heavy investment phase and is now just harvesting massive cash returns. That structural shift justifies adding points to the final score.
Right.
The second modifier is the hidden Markov model regime, or the HMM regime, which shifts the score by -5 to +5 points based on the overarching macroeconomic weather. A persistent bull regime with 95% probability adds 5 points. A persistent bear regime subtracts 5. A flat regime with a TrendWise open signal adds 3, while a flat regime with a closed signal subtracts 2. This ensures that the portfolio is constantly adjusting its beta profile based on the statistical reality of the broader market, not just idiosyncrasy stock trades.
And after all components and modifiers are synthesized, we arrive at the grade scale realization. The translation is absolute, and this is where the system really imposes its will on the portfolio manager. Yes. A score of 80 to 100 dictates a strong buy, signaling maximum position sizing and full conviction. A score of 65 to 79 dictates a buy, representing a normal position within established risk limits. A score of 50 to 64 is a watch, requiring the manager to monitor the asset, build conviction, and maintain only a small position. A score of 35 to 49 is caution, mandating a reduction or total avoidance of the asset. And below 35 is avoid, dictating zero position and active risk mitigation.
Which brings us back to the central tension here, right? Does the difference between a 79 and an 80 truly change the economic reality of a company, or is it just a psychological threshold?
That is the question.
I argue that the threshold is absolutely vital. It translates a continuous, messy spectrum of probabilistic risk into a discrete, actionable mandate. Without that hard line between a 79 and an 80, the portfolio manager is forced to justify sizing decisions subjectively. The manager will constantly negotiate with the data, arguing that, well, a 79 is close enough to an 80 to warrant a full position, especially if they have an emotional attachment to the thesis.
They always have an emotional attachment.
They really do. By making the scale absolute, the system severs that emotional attachment entirely. The math decides the mandate.
The scale appears theoretically flawless on paper. The logic holds up. But historical backtesting is literally littered with perfectly symmetrical, elegant models that fail catastrophically in live out-of-sample markets.
Sure, overfitting is always a risk.
It's more than a risk, it's an inevitability without the gates. This brings us to the empirical proof validating why the scale absolutely must be constrained by the gating architecture. The architecture we're discussing isn't just some philosophical exercise. It is a direct response to the stark realities of quantitative failure. The 2026 Financial Analyst Journal study by Zhou and Kim serves as the empirical bombshell that validates this entire gating architecture.
The Zhou and Kim paper is remarkable.
It really is. Their first major finding addresses the crisis of overfitting in machine learning models.
Overfitting is the silent killer of quantitative funds. A model is trained on historical data, and it finds, thousands of minute correlations that produced alpha in the past. But they don't hold up.
Precisely. In-sample variable importance consistently overfits to historical data. Models that look mathematically brilliant in backtests fail in real time because they memorize market noise rather than identifying true economic signals. The machine learning algorithm does not know the difference between causation and correlation.
Right, it's just finding patterns in the noise.
Yes. It might find that a stock performs exceptionally well when a specific set of highly obscure macroeconomic variables align, and it aggressively weights those variables. In live trading, that correlation falls apart, and the model just bleeds capital.
The composite score survives this precise trap because it relies on fixed weights for its components, rather than continuously optimized parameters that chase past performance. The gravity walls will always be 25 points, TrendWise will always be 15.
It can't just change the rules?
Exactly. The model cannot suddenly decide that a volatile momentum indicator is worth 40 points just because it worked flawlessly over the last 6 months. The fixed weights prevent the system from structurally overfitting to recent noise.
And the Zhou and Kim study also highlights a second massive vulnerability in traditional quant models, which is the mirage of alpha in microcap stocks.
Yes, their second finding reveals that conventional quantitative models are massively inflated by microcap returns. A backtest will show these extraordinary annual returns, but when you look under the hood, the algorithm is constantly allocating hypothetical capital to highly illiquid microcap stocks that you could never trade at size in the real world.
Without blowing out the spread?
Right. You'd blow out the spread and completely destroy the theoretical alpha. This finding directly validates the geometric order gate within our framework. When a microcap asset hits geometric order 2, it is explicitly flagged as illusory. The system recognizes that the theoretical liquidity does not match the actual market depth, and it restricts capital deployment. It builds real-world friction into the math.
But the third finding of the Zhou and Kim study, that is the true empirical bombshell. It challenges the fundamental assumption of the entire big data era in finance.
It certainly does. The third finding demonstrates that certain machine learning predictors actually carry negative importance.
Wow.
Yes, including these predictors in a model makes your portfolio objectively worse, not better. They introduce active degradation. For decades, the assumption in quantitative finance has been that more data, processed by faster computers, automatically leads to higher resolution and better decisions.
The more data, the better.
Exactly. But Zhou and Kim prove that this is false. When an algorithm is fed unrestricted data streams without rigid economic boundaries, it eventually indexes on highly complex, noise-driven signals. These signals are mathematically robust in a vacuum, but carry negative economic importance in a dynamic system. Following them practically guarantees underperformance.
A negative importance finding perfectly frames the necessity of the 7x conditions. If unchecked machine learning can actively degrade a portfolio, then the human architecture has to force the machine to obey strict laws of economic physics.
Yep.
Every single one of these 7 hard conditions must be met simultaneously to authorize capital deployment. First, 3 or more gravity walls must be green. We demand absolute fundamental confirmation. Second, the market clock must be favorable, specifically a phase 2 right side or phase 4 left side position. We demand optimal cycle placement. Third, the corporate stage must be between 2 and 5. Strictly excluding stage 6, we frankly refuse to finance structural decline.
Let's list the rest, because each one is a barricade against that negative importance. Fourth, the geometric order must be 1 or below, ensuring mathematical stability in the price action. Fifth, the formula weight must be at least 2%. We do not deploy capital for trivial exposure.
Right, it has to be worth the risk.
Exactly. Sixth, TrendWise must be open for a right side position, though closed is acceptable for a left side position at half size. And seventh, the sector and industry must be at least neutral. We will not swim against a macroeconomic rip current.
These 7 conditions act as an impenetrable filter, ensuring that only the most robust multidimensional setups translate into actual portfolio positions. You can have a brilliant machine learning model generating hundreds of highly ranked stock ideas. If those ideas pass through the filter and emerge on the other side, you have high conviction alpha. But if an idea generated by the model fails even one of these 7 conditions, it is immediately discarded.
Which is the strongest argument for the absolute supremacy of the hard gates over the composite score itself. These aren't arbitrary filters layered over a score to make the portfolio manager feel safe. They are explicit economic restrictions that prevent noise-carrying signals from contaminating the portfolio. Machine learning and quantitative scoring can only deliver robust, forward-looking insights if they are forcibly restricted by economic reality.
I agree, but
Let me just finish the thought. If a model generates a brilliant predictive signal calculating a theoretical score of 95, but the asset is a stage 6 company in a declining sector, the signal is statistically likely to be a manifestation of negative importance. The algorithm has found a spurious correlation that looks like alpha but is actually a trap. The gates serve as the immune system of the portfolio, aggressively rejecting signals that lack multidimensional economic confirmation.
Hold on. You're arguing that the gates are supreme, but the gates themselves are derived from the exact same economic theories that construct the score. The gates are just the binary expression of the continuous variables measured by the composite score.
They're the enforcement mechanism.
Right. The score measures the magnitude of the signal, while the gates measure the validity. You can't have an immune system if there is no underlying organism to protect. The framework absolutely requires both. However, if we accept that negative importance proves noise can infiltrate even the most sophisticated predictive models, there must be a mechanism to shut the entire system down when the broader environment becomes completely toxic, and the hierarchy provides that mechanism.
The true climax of this entire framework is indeed the override hierarchy. Above the points, above the modifiers, above the grade scale, sits an architecture of absolute veto power. The system is designed with the humility to recognize that financial markets occasionally just break. And at the very top of this hierarchy sits Shannon entropy.
Shannon entropy is a concept originally developed in information theory, measuring the unpredictability or complexity of a system. How does this translate to a hard market override?
Think of Shannon entropy in financial markets like a packed football stadium. Normally, 80,000 people are having 40,000 independent, uncorrelated conversations. Some are buying, some are selling, reacting to diverse information streams, earnings reports, central bank policy, idiosyncratic technicals. That is a healthy computing market with high entropy. The system is processing information effectively.
Okay, I follow.
But what happens when a fire alarm goes off in the stadium? The entropy compression compresses immediately. The 40,000 independent conversations cease to exist. Everyone looks at the exact same exits and rushes toward them simultaneously. The market has collapsed into a singular, correlated herd movement. During extreme entropy compression, even perfectly calculated fundamental and quantitative analysis becomes temporarily irrelevant. The market has effectively stopped computing individual asset values. It is only computing liquidity and panic.
Right, so in this state of extreme entropy compression, Shannon entropy suspends all underlying signals entirely. The system recognizes that the fire alarm is ringing, and it tells the portfolio manager that any 0 to 100 composite score generated during this period is fundamentally compromised. The individual fundamental gravity walls really do not matter when the entire market is liquidating.
Exactly. And below entropy sits geometric order, which is the structural manifestation of mathematical chaos in an individual asset. Order 0 earns 10 points in the composite score. Order 1 earns 8 points. Order 2 earns 3 points. And Order 3 earns 0. But geometric order functions as far more than just a point contributor. It is a hard, structural gate that commands the ultimate veto.
It dictates action.
Yes. Order 2 blocks all new position entries, regardless of how attractive the fundamental valuation appears. The volatility is simply too high to trust the entry signal. But Order 3 overrides everything in the system.
Let's consider an illustrative scenario to demonstrate the power of this mechanism. Imagine a highly compelling software stock achieves a near-perfect composite score of 95. The gravity walls are completely green, generating maximum fundamental points. The moat is mathematically expanding, adding further structural support. The market clock is perfectly aligned in the Phase 2 sweet spot. The long bull blueprint modifiers are entirely positive.
The perfect setup.
Exactly. The portfolio manager looks at the dashboard and is eager to deploy maximum capital into what appears to be a generational opportunity. But suddenly, as a result of some exogenous shock or, hidden internal leverage unwinding, the asset's geometric order violently shifts to 3.
A stock scoring 95 with an order of 3 still mandates an emergency exit. The ultimate tension of the framework is resolved right here. The composite number tells you what you should ideally do in a rational environment, but the override hierarchy tells you exactly when you must ignore the number to survive.
The math yields to chaos.
Yes. The Order 3 designation means the asset's price action has broken the boundaries of predictable geometric expansion or contraction. It has entered a chaotic state where the underlying fundamental math can no longer govern the price. If you stay in the position because you trust a 95 score, you are assuming that the market will immediately become rational again. The hierarchy demands that you exit the burning building first and calculate the intrinsic value of the ashes later.
So, how does this philosophical hierarchy translate into actual portfolio weight? Because the mechanics of capital deployment are where theoretical points become tangible risk. A brilliant analytical system is completely useless if it can't correctly dictate how much money to put on the line.
Right.
We move from the composite score directly to the allocated weight. The base weight of any position is derived directly from the gravity walls. This anchors the physical capital to the fundamental reality. 4 green walls establish a baseline allocation of 6% of the total portfolio. 3 green walls establish a baseline of 4%. From this fundamental baseline, precise adjustments are made. The base weight is modulated by extreme composite scores, dual clock signal alignments, and specific dividend yield thresholds.
But once that preliminary weight is calculated, the gates step in to dictate the final executable size. The theoretical weight is constantly checked against structural reality. The geometric gate dictates that Order 0 and Order 1 allow for the full calculated position size. But if the asset slips into Order 2, the gate restricts the position to half size and permits exit-only execution. You can trim, but you absolutely cannot add.
Which makes sense. You're managing volatility.
Right. And Order 3, as we discussed, forces the position size to absolute 0. The TrendWise gate dictates that a right-side open signal permits full size, while a left-side closed signal restricts the position to half size, demanding caution when fighting the primary trend. The sector gate applies the final modulation, providing a 0.5% tailwind addition for favorable sectors and imposing a 1 to 2% headwind reduction for unfavorable ones.
Finally, strict absolute risk limits govern the entire output, acting as the ultimate backstop. No single position may ever exceed an absolute cap of 8%. Why 8%? Because idiosyncratic risk cannot be completely engineered out of existence. Black swan events occur, corporate fraud occurs, even if a stock possesses an immaculate 100 composite score, a phase 2 clock, and an order of 0. An 8% cap ensures that a single catastrophic failure cannot destroy the portfolio's compounding trajectory.
You have to protect the downside.
Always. Conversely, no position is worth taking if the framework dictates a size below the minimum threshold of 2%. If the conviction is so thoroughly diluted by the gates and modifiers that you only want to allocate 1.5%, the position is merely an intellectual distraction. Position sizing is the ultimate manifestation of the framework. It ensures that capital is deployed not just on the conviction of a single score, but mapped precisely to the structural permissions granted by the hierarchy.
Which brings us to a critical realization about the future of quantitative finance. If the Joe and Kim empirical study proves that machine learning models actually carry negative importance without strict economic gates, and if entropy can compress to shut down even the most fundamentally sound signals, we must look at the broader industry. What happens to the highly leveraged, unconstrained quantitative funds running black box algorithms during the next structural regime shift?
This is the research desk officially signing off.